Hi, I'm David Thompson. This TRIDcast is being provided by Docutech Corporation. Welcome to Episode 6, Introduction to the Closing Disclosure. Docutech is committed to consistently delivering fully compliant loan documents. As a company, we recently asked our clients what we could do to support their transition to the new integrated disclosure. This TRIDcast series is designed as a direct response to the feedback we received. Today we are privileged to hear from Fred Gooch, Docutech's General Counsel and Vice President of Compliance, and Timothy Rady, Regulatory Compliance Specialist. Timothy Rady is responsible for maintaining and auditing Docutech's state disclosure matrix and state-specific mortgage loan disclosures. Timothy's efforts play a key role in helping Docutech's customers prepare for the upcoming TRID reform. Fred and Timothy, thank you for being with us today.
Thanks, David. It's good to have Timothy with us again today. He is the resident guru of Docutech's state disclosures and the primary architect of our TRID requirements document that we generated back in June when we initially kicked off the development phase of this product. So we're happy to have Timothy with us here.
Thanks, Fred.
Today we're going to dive into the closing disclosure. So our primary purpose is to simply give a overview of the closing disclosure, some of the basic requirements, and exactly what is included on the closing disclosure. We're not going to go into a lot of detail. We'll save that detail as we drill down in more depth into specific areas of the closing disclosure and the loan estimate on later TRIDcasts. So the general requirements for the closing disclosure are, number one, that it is required for all loans where a loan estimate is used. Now remember, a loan estimate is required for all applicable loans where the application is made on or after August 1st of 2015. So the rule is, if you use a loan estimate, then you have to close with a closing disclosure. If you disclosed early on with a GFE and a TIL because the app was prior to August 1st, then you're going to continue to close your loans with the HUD-1 and the final TIL disclosures. Now, in the circumstances where it's applicable for applications on or after August 1st, this new closing disclosure will replace your HUD-1 and TIL disclosure. It's a document that has to be in writing, and it has to follow the form that is outlined in Appendix H25 to the new rule. Now we're going to talk about briefly about the delivery requirements for the closing disclosure.
So like the LE, the CD is required to be provided a certain number of days before consummation. An initial CD must be received by the consumer no later than 3 specific business days before consummation. However, if the CD is mailed or electronically delivered, the consumer is considered to have received them 3 specific business days after they are delivered. Taken all together, this means that the CD must be placed into delivery at least 6 specific business days before consummation. For example, if consummation is scheduled for a Thursday, the CD must be received by the consumer on a Monday, 3 business days before Thursday. However, in order for the consumer to have received them on Monday, they would have had to have been delivered the previous Thursday, 3 business days before they were received. So altogether, it would have to be sent out the previous Thursday in order for consummation to occur on the next Thursday. There are different timing requirements for a revised CD. If a revised CD is required due to the APR becoming inaccurate, the loan product changing, or prepayment penalty being added to the loan, then a revised CD must be delivered and received by the consumer like an initial CD, basically put into delivery 6 business days before consummation. However, if a revised CD is required due to any other changes, then it need only be received by the consumer at or before consummation. However, the creditor must permit the consumer to inspect the revised CD during the business day immediately preceding consummation.
So Timothy, there's a whole lot of rules about delivery of the closing disclosure, and a whole lot of specific scenarios that we'll probably need to dive into in more detail on a later TRIDcast. But suffice to say that the general rule being that it's 3 specific business days prior to closing, right?
That's correct.
Yeah, and we'll, like I mentioned, in a later presentation, we'll probably go over some specific scenarios and some calendars, put up some calendars on the screen so that we can go through how all those play out and some of the specific examples to the rule. But at the end of the day, you're waiting once again, right? The borrower and the lender, we all have to wait a little bit longer than we are in our current business process. Now, as Timothy mentioned, the consumer has to receive the closing disclosure 3 business days before consummation. And we've talked about this before, but as a reminder, consummation may be at the same time as settlement or closing, but not necessarily so. Consummation occurs when the consumer is contractually obligated on the loan with the creditor. And when that happens is actually going to be determined by state law. And I know we've talked about this on several of the presentations, but the way that most of the systems are going to work out there, in fact all of the systems that DocuTech is working with, this is going to be treated such that consummation will be treated as the settlement or the closing date. Because if you had consummation as a different time, almost always it's going to be after the settlement or the closing date. So remember, consummation is when the borrower is contractually obligated on the loan. It depends on state law, and it most commonly will occur on closing or settlement. With that, we've covered some of the preliminary matters dealing with the closing disclosure. So let's go ahead and take a look at the document and take a tour of what's included and what's required to be disclosed in the closing disclosure. So in order to do that, we're going to pull up a copy of the closing disclosure out of our Conformix system. So here's the closing disclosure that we have drawn out of Conformix. Now remember that this is a test loan, so all of the data might not be as accurate or as clean as it would be on a regular production loan that is in Conformix. But this is an actual document that is being used for testing right now in our system. And so we're going to go ahead and take a look at the first page. Timothy.
Okay, so page 1 of the CD is very similar to the LE in many regards. Basically, you're going to have the same closing, transaction, loan information, which is disclosed at the top of the form, followed by the same loan terms, projected payments, and cost of closing tables. There are, however, a few noteworthy differences. With the information tables, more disclosures are provided than on the LE, such as the loan file, MIC numbers, seller's name and address, and closing disbursement dates. One item that's missing from the CD from the LE is the rate lock disclosure, because of course that's largely inapplicable by the time consummation comes around. In the projected payments table for loans subject to RESPA, the escrow account analysis set forth under RESPA is applied to the escrow and taxes, insurance, and assessments amounts disclosed, which is not applied on the LE. And for loans which are not subject to RESPA, you can still use the escrow account analysis for RESPA in disclosing those amounts.
Okay, so basically you've got a page 1 of the closing disclosure that is very similar to what we have on the loan estimate, right, Timothy?
Very correct.
A few small changes. Okay, let's go ahead and take a look at page 2 now. Page 2 is going to remind you of some of the things that you saw disclosed on page 2 of the loan estimate. So this is where the disclosure of the loan costs and the other costs that were disclosed on the loan estimate is the final amounts are disclosed in this part of the closing disclosure. So if you take a look at the loan costs, you've got 3 categories. You've got the origination charges, you've got the services that the borrower did not shop for, and the services that the borrower did shop for. And then you've got a summation of all those costs in the total loan costs section. Also, what you will notice here that's different from the loan estimate is you've got a split for the amount that is paid by the borrower at closing versus the amount that was paid by the borrower before closing. Also disclosed on the closing disclosure can be the amounts that are paid for by the seller. Now that column doesn't appear on this document, but in transactions where there is a seller, you'll have a separate column also that has the ability to show amounts that the seller paid at closing and the amounts that the seller paid before closing. And then you've got that final column which would include amounts that are paid for by others. So if you look at section B, the services the borrower did not shop for, you can see that the appraisal fee of $405 was paid for by the lender, and so therefore it appears in the paid by others category. Now, if you scroll down to the bottom of the page, we have the list of the other costs. So we have sections E, F, G, and H, which is our taxes and government fees, the prepaids, the initial escrow payments at closing, and then the other charges. And then those items are all totaled in the other cost total in section I. Once again, you've got different sections here for the amounts that the borrower paid before closing and at closing, as well as you could have amounts disclosed here that were paid for by the seller at or before closing, and the amounts that would be paid for by others. At the very bottom of the page here is section J, which is the total closing costs, which simply adds up the amounts of the loan costs and the other costs, and then also has a section there for lender credits, which could be subtracted from the total there if you had lender credits on this loan. Now, there could be circumstances here where you're going to have too many fees to fit on the page. And so the instructions do allow you to add additional lines or subtract additional lines to make everything fit on the page, as long as everything stays in the same categories and in the same format as is required in Form H25. Also, you could even have enough where you would split it into 2 pages, right, Timothy?
That's correct.
So you would, in those circumstances, you would have a page 2A and a page 2B to the disclosure. And it would probably be divided along the lines of the loan costs and the other costs, one on each page. That's one of the nice things about the Conformex system, is it's dynamic and it can dynamically add or subtract lines to make things all fit on the page in most circumstances, unless you've got a whole bunch of fees. So let's go ahead and move on to page 3.
So, speaking of dynamics, page 3 contains 2 sections that are fairly dynamic. The first one is going to be a calculating cash to close table, which compares the amounts disclosed in its sister section on the LE against the final amounts actually being assessed. Not only is the comparison done, but a disclosure for each item is made, either indicating that the amounts did not change between the initial disclosure of the LE and the closing disclosure, or that they did change, and an explanation or cross-reference as to why. The second section is basically a new and improved version of page 1 of the HUD-1. It summarizes the amounts due from both the borrower and the seller at closing, amounts due to the seller at closing, and amounts paid before closing by the borrower. Amounts disclosed include the sales price of the property, adjustments for various taxes and assessments, deposits, payoffs of existing liens, and seller credits. This second section can, in connection with a refinance transaction, be replaced with a payoffs and payments table, which simply lists previous debts being paid down or off by the proceeds of the new loan. The second section can also be split to only disclose the borrower or seller specific parts of the section if a separate CD is being provided to the borrower and the seller, in order to segregate out their different information for privacy purposes.
Okay, now we're going to go ahead and take a look at page 4, which is a page that's basically full of a lot of disclosures. It's entitled Additional Information About Your Loan. I view this page as a page that is in here to fulfill a lot of the statutory requirements for disclosures and maybe consolidate and eliminate some of those requirements that we've had to put in other documents before. So if you go ahead and you look at the first section, you've got the assumption disclosure, which is currently on the till, and that informs the borrower whether they are able to have their loan assumed or not. The second disclosure has to do with whether the loan has a demand feature. This is also a disclosure that's included on the current till. So this disclosure will let the borrower know whether there is a feature which permits the lender to require them to pay the loan early. The next disclosure is for the late fee. So here you have an example where if the payment is 15 days late, it informs the borrower that they can be charged a 5% penalty of the monthly principal and interest payment. The next disclosure here on page 4 talks about negative amortization. And so you have 3 different options here that can inform the borrower if their loan has a specific negative amortization feature on their loan. The first box you would check if you had a loan where there was going to be negative amortization according to the terms of the loan. The second box, you can see that it says that there may be negative amortization. So this might be in a circumstance where you have some kind of an option arm, where if they only make a interest-only payment, or if they make a lower payment that's allowable on the loan, then negative amortization would occur. The third box simply says that there is no negative amortization. The next section is the partial payment section, and this informs the consumer whether or not their lender will accept partial payments. And then also the next one, disclosure down here, is the disclosure of the security, interest, and this informs the borrower that a security interest is being taken on their property and gives the address as well. So there's no question about if there are multiple properties, which properties have a security interest being taken in them. These are really all disclosures that would previously have been included on the TIL disclosure in one way or another. Next, you have a disclosure about the escrow account. So it informs the borrower whether or not they have an escrow account, and it gives them some estimates of the costs that will be included in the first year. So you've got a box that tells the borrower how much of their property costs would be escrowed in the first year and how much of their property costs, taxes and insurance or homeowners association dues would not be included in escrow. And then it gives them the total escrow payment and the monthly escrow payment. Now there's a box here following that which says whether or not the borrower will have an escrow account and if they declined it or if the lender does not require one. And if they do not have an escrow account, then you're going to see the bottom section of the document be completed, which gives them an estimate of the property costs over the first year, since they're going to be paying it themselves, not out of escrow. And it also includes a place where you can disclose the escrow waiver fee if that is applicable. Then you've got some language here that informs the borrower that these costs can change over time as costs associated with the property change, taxes, insurance, homeowners dues, those kind of things. Also included on page 4, and I don't think we have it on this particular disclosure right here, but at the very bottom it would be the place where the adjustable payment table would appear, which is similar to the one that's in the loan estimate if you had a loan where the payments changed for a reason other than the interest rate. Or you could also have the adjustable interest rate table, which explains to the borrower how their loan is going to change if they have a loan with an interest rate that can change. I think that's everything on page 4. Did I miss anything, Timothy?
I think you got it.
All right, that's a mouthful. On to page 5.
Okay, so the final page of the CD discloses general financial terms of the loan, which helps the borrower determine what the true costs of the loan are going to be. These are found in the loan calculations table up there in your upper left side of the screen, and include the total amount of money being paid in payments, the total finance charge and APR, and the new total interest percentage or TIP, which discloses how much interest the borrower will be paying over the life of the loan in comparison to its loan amount. On the upper right side of the screen, under the other disclosure section, certain disclosures about items related to the closing of the loan are provided. These include notices about borrower receiving a copy of the appraisal report, reviewing their note in a security instrument for details about the terms of their loan, whether or not they may be liable under state law in a deficiency judgment if the dwelling is foreclosed on, and that a refinancing of the loan may not be guaranteed, and information about tax deductions on interest. There's also a prominent disclosure with a prominent question mark referring the borrower to the CFPB if they have questions about the loan terms and costs on the CD, or if they want to make a complaint. There's also a contact information table which provides detailed information concerning the lender, mortgage broker, real estate brokers, and settlement agent involved in the loan transaction. This information includes these entities' names, addresses, NMLS ID numbers or state license numbers, email and phone number. There's also information for the primary contact for each of those entities, including their name, NMLS number, or state license number. And then finally, you have the confirm receipt signature area at the bottom of the form, which we recommend is a good practice to have all the time. It doesn't have to print there. If it doesn't print there, a disclosure will print up in the other disclosure section. But a lot of the state laws do require a settlement statement or the equivalent of it, which the CD arguably is, to be signed by the borrower. And so we would recommend that clients consider using the confirm receipt section if that fits with their practices.
So what you're saying is that this confirm receipt section is optional, but if you don't have it, an additional disclosure is going to appear in the other disclosure section, right?
Yep, that's correct.
Now, I notice on this particular document, we don't have a place in here for seller signatures. How would that generally be handled on the closing disclosure?
We will be providing an addendum to the closing disclosure with the seller's signatures and acknowledgement on it. This is largely due to Fannie Mae and Freddie Mac's requirements. that an addendum appear with the settlement statement in which the seller signed.
Okay. Another thing that I think is interesting about this page is you've got some disclosures here that are generally given in separate disclosures in our current practices right now that are now included on page 4 and on page 5 of the closing disclosure. So I see the appraisal language is on here. Does this mean that Docutech will be not providing their current appraisal disclosure with these documents when they print?
Yeah, that's correct. The current appraisal disclosures are required either for all first lien loans or for higher risk, higher price mortgage loans, which would involve a lot of second lien and first lien loans. So with the exception of home equity loans, the loan estimate is going to be given for practically all first and second lien loans. And so this appraisal disclosure requirement will satisfy requirements under the Dodd-Frank Act. We will still need to provide a separate appraisal notice, the one required under ECOA for home equity loans, but for most of our loans, this should cover the base.
Great. So Conformex will be programmed to know all those scenarios and know when to print a separate appraisal disclosure and when you're covered by the disclosure that's made here in the closing disclosure.
Yeah.
Another thing that I notice here is the liability after foreclosure section, where you have to disclose whether there may be liability after foreclosure or the state does not allow liability after foreclosure. And we get a lot of questions from our clients right now about this. So that's one of the things that we've been working on in our compliance department at Docutech. We're in the process of finalizing a liability after foreclosure matrix that we're going to be publishing on our website here in the coming weeks. And that will tell you what our standard defaults are going to be for how we're going to check these boxes. Now you will have the opportunity to override them and send your own data or do your own mappings if that's what you desire, but we will have a default setting of how the document will perform outside of any other informational requirements that we receive. Okay, that does it for our broad overview of the closing disclosure today. I want to thank Timothy for being with us here today and for sharing with us his knowledge about this document, the closing disclosure. I also wanted to remind you that we did just give a very quick and a very brief overview of this document today. Our intention is to drill down with more specificity into the different areas on the closing disclosure in later presentations, especially those that seem to be troublesome or those that we're getting a lot of questions about. So please submit your questions that you might have so that we can make these presentations useful and most beneficial to you. We would much rather spend our time addressing your questions than going through what we think is important.
Fred, Timothy, thank you.
Thanks, David.
Docutech would love to field your integrated disclosure questions. Please submit your questions to trid@docutechcorp.com. Our next episode will be on May 5th, 10 a.m. Mountain Daylight Time, where we will be discussing delivery and redisclosing the closing disclosure. To learn more about Docutech, see previous episodes, or get a copy of today's show sheet, visit our website at www.docutechcorp.com. You can also reach a member of our team at 800-497-3584. And again, thanks for watching.